Welcome,
Hey,
everybody. Try it
Let's
again.
try it again. Welcome, everyone, again to the Strong Valley Mid-Quarter Roundtable. You've got Chris, Adam, Kyle. I'm Jason. And we want to kind of dive into some stuff that's been surprise to a lot of us, I think. You know, most people didn't expect the markets to be up at all this year, waiting for that proverbial shoe to drop with this recession we've been talking about for a year. But here we are. Most of markets are up, led by tech. The big conversation around AI. I don't think 6 months ago anybody knew what ChatGPT was, and now everybody's talking about it and where AI is going to have us in years to come. So, you know, as we look at the markets now, and we see where the Dow, the S&P, and the markets that we all track and follow, you know, the Dow is basically flat here year to date, but the big driver behind the market has been tech, and that's what's been driving the S&P 500. The S&P 500 is up about 8% on the year, but if you take away the big tech, it's essentially flat, nearly flat, the same as the Dow Jones. But what I'm going to pull up really quick, I want to pull up the chart of the NASDAQ, and what you're going to see here is what's been the driver here. You know, so when we look at the big names that drive the NASDAQ, Apple, Microsoft, NVIDIA, Tesla, Facebook, etc. You know, there's been a giant run since October, but if you look here at this chart, it's really just been clawing back a lot of the losses from last year. And so these prices, you know, everyone's betting on this AI revolution to come through, and that's really driving a lot of these prices. I'm sure you guys are seeing a lot of the same thing here. But
yeah, for sure.
But it's been pretty nuts. And we're recording this as NVIDIA, a big name in the NASDAQ and a big name in the S&P 500. NVIDIA reported earnings, and the stock is up nearly 30% today. And that's a big driver for the market as well. But the majority of our clients do not have concentrated artificial intelligence portfolios. And so it's a little misleading as we kind of look through the data and look underneath all of this. If you take just five to eight tech names out of the market, and you've got basically the S&P 495, the market's relatively flat.
Yeah, I saw a stat on that the other day, Jason, that we were looking at it. It was the top 8 performing stocks in the S&P 500 account for 23% of the index and 90% of the return. Mm-hmm. So there's 500 stocks, and then the top 8 represent 23% of it and 90% of the return for the year. So that goes along with what you're saying. That
we're starting to see that more and more too, with with the globalization of economies and how things with the internet has changed everything. Big names are driving stock performance up and down. You know, more in the last probably decade than ever before.
Yeah. Well, and that's where, I mean, we don't know yet what this AI drive is going to do. It's a lot of hype. It's a lot of excitement right now, given why everyone is buying to the tech. I remember reading a quote where someone said, you know, usually when you have a brand new technology, a brand new trend, it's usually overpriced or overestimated in the beginning and then underestimated in the long run. And so, you know, you can kind of relate this to internet.
That'd be like a cryptocurrency type thing.
That could be like crypto. That could be, well, we'll see in the long run if it's underestimated, but you could look at look at the internet. So you look at the .com boom of the 90s and what all those crazy stocks did. I mean, from Cisco Systems to a lot of the names that are gone, Sun Microsystems and all these others. Yeah. And so in the beginning, it was overestimated. The PE ratios and everything was to the moon. And so we had the tech crash, but then everyone in the 90s probably got underestimated to what we use the internet today.
For sure.
And AI may very well be similar. So right now, a lot of these companies are going berserk. There will probably be some kind of check back, but then who knows where AI will be a decade from now. Probably underestimating.
Like any of those technologies, though, you have a couple of winners. You know, not everybody's going to be the leader. There will be a couple of companies that really come out and are the big wigs as far as artificial intelligence go. And I think some of those companies have already been scooped up by Google and Microsoft and some of those. So that may be leading some of the concentration that you're talking about in the index, where, you know, Microsoft is doing really well and Apple's doing really well and Google's doing really well. And that's where, you know, that's where a lot of those smaller companies have already been scooped up, and that's how they become parts of the portfolio there.
As far as the concentration, we don't have a chart on this, but I was looking at it. This is the first time, I think, in maybe 50 years or ever, where your two biggest companies in the index, Apple and Microsoft, just the two of them represent 14% of the market.
Yeah.
which is pretty crazy. So yeah, there's a lot of consolidation going on for sure.
Mm-hmm.
So this is a lot different too than what we saw last year, right? I mean, last year, whole conversation was around, interest rates, inflation, and how poor the NASDAQ and the tech stocks were doing relative to the value. And that was just kind of
Glad you brought that up. Everybody's just about to sell all of their value and buy tech.
When last year it was sell tech, sell everything that looked like growth, buy dividends and buy oil companies, and buy energy, because oil was going up and we didn't know when that was going to go down. And especially with the fear around Ukraine war and energy prices, et cetera. So I think we got a chart on that, the 22 versus 23. This one's pretty neat.
Yeah, you don't see this very often.
Yeah, and so what you're seeing here is the dramatic difference between last year, which was in red, and this year to start the year in blue. And so, we can all speak a little bit about what we see with clients. And so often, we had battled conversations last year about, why am I in these growth stocks? I shouldn't be in these growth stocks. Shouldn't we just have more energy, more oil? That's the only thing that's working. And now you look this year, it's the worst performing thing that you could have owned. And so this is a great case just for diversification, kind of stay in the course. Your investments kind of move like pistons in an engine, and what goes down comes back up, and what goes up may come back down. But trying to time that is pretty impossible. Yeah,
and that kind of goes to what Chris was saying too about the single stock. I mean, you got the NVIDIA, right? NVIDIA announced yesterday, and that was, that's all everybody's talking about. But for every NVIDIA, there's 15 others that you could have owned for the last 10 years and made zero money.
Mm-hmm.
Right.
You said single stock is definitely a crapshoot. You hit it right every here and there, but the case for diversification can be made.
Well, and that goes back to what we were just talking about a little bit ago too, Jason, on it with, we talked about this year being the growth into technology. Last year was the opposite. And then we go back to 2020, even the year before, and it was, COVID, everything shut down and growth takes off and value goes down. And so from year to year, the last 3-4 years, it's kind of been a flip flop between growth and value, where, picking that right sector, that right growth or value every year has been really tough.
Well, it makes a case to own both, and it makes a case to be diversified. We're all guilty of this, and I've talked to many clients where they will look. I mean, most people look at their statements and they look at the bottom line and see if it's growing over time. That's what we all want to see. But often, as you flip into the pages, you look at the minutia, all the detail of the positions, and we've all had these conversations with the client. Where the client has, let's say, 10 different positions, and the only 3 they want to talk about are the 3 that are down, not the 7 that are up, let's say. And here's how the common conversation goes. Hey, these 3 that are down, shouldn't we sell these because they're going down and buy more of the ones that are doing well? And we've all been in that position as we feel selling the dogs in the moment. But if you look at just that chart we had, it would have been the exact opposite thing to do. I mean, and in actuality, we ought to be, if we're going to be trimming from the ones that are doing well to buy more shares of the ones that are down. And that's usually what we end up doing in a rebalance anyway, is doing just that. Trimming off profits of things that have been doing well to buy more shares of the things that are down. And over the last year, in hindsight, that would have been the perfect thing to do.
Yeah, for sure. So let's talk a little bit about something we talked about for the last several months, probably the last year. Inflation and driving the market. So inflation's been high. It's down to 4.9% now year over year. It's the lowest that's been since April of 21. It may not feel like it if you live in California like we do, because I think I just paid $5 at the pump yesterday, but that's a lot of taxes and extra stuff. But inflation is, believe it or not, down, and that is helping drive market performance for this year. And again, hasn't been all world, but decidedly better than last year. And that's correlated very closely with the Fed funds and reserve rates and expectations. So we've had tons of hikes. I think 10 since March of 22. I think we had a slide on that too with the rate hikes, just to see how fast. And if we had a chart before, I know we've used in Monthly Market Matters, where you see the slope of the chart. This just shows you the number of rate hikes, but how fast and how quickly they've hiked rates this time has been like nothing else we've ever seen. So it was just, we've been talking to clients a lot about January of 22. In January of 22, you were earning nothing on your bank deposit and your money market. We didn't even buy money market because it didn't pay anything. And that was, 15 months ago, 16 months ago. And, we'll talk about later, but now it's almost at 5%. So things have changed dramatically. But we do feel like we're probably in the market feels like probably at the end of the rate hikes. I know the Fed has talked about maybe having to do 1 or 2 more. The market isn't buying into it. They believe, by the end of the year, we're probably into cuts. But bottom line, we're somewhere near the top, and that's also, helping the market.
Yeah, that's 5% right there from essentially the floor to
Yeah.
where we're at today. And that's just unprecedented. I mean, I remember when they got that first 75 basis point hike last year, and everybody about fell out of their chairs, and we got 4 in a row. So
Yeah.
but you're talking about the slope and how fast it went up, going from 0 to 5 in less than a year is a pretty aggressive move.
Yeah, it just kept coming.
I think it's a common question that clients are asking us, though, is how much more do we have to endure? How far can the rates go? And like you said, Adam, I agree. I think we're close, and the market agrees too that I think there's a 70% chance on the next Fed meeting that they pause. I think it's something like that, maybe about a 20% chance they may go a quarter of a point.
I think I have that slide I can pull up too on that, Jason.
And
sideways.
Turn my head sideways. But anyway, that's the gist. And I think, and from what and again, Jerome Powell won't say this, but I think what we're all kind of reading the tea leaves there is they're trying to get a hold of inflation. They're trying to, the whole reason why we did this and why they raised rates was to control inflation. They're not done, but they've got it down from 10 to 4. And there's still more to go. But I think they're hoping that the rate hikes they've done will continue to push inflation down without them having to continue raising, because they also know too that if they raise rates too much, then you're probably going to see more bank failures and a potential for really hurting the economy. And so they're kind of walking a tightrope there. But I think that's a consensus. They're going to sit still.
Yeah, not just bank failures, but they're really trying to get employment sort of under control too, because cost of labor is skyrocketed, as most of us can attest to. And with more and more corporate layoffs being announced, they're getting what they want really by with the product of those rate hikes.
Kind of off topic, but similar, I guess. I was just on the phone yesterday with my brother-in-law, and he works with a couple of very large hotel chains all around the country, and he's in charge of hiring and firing, et cetera. And he called me. He said, "Hey, what do you know about any big changes recently in the economy?" And I go, "Well, what do you mean?" He said, "For the first time ever, my bosses are all telling us to slow down and start actually laying people off." So I guess in the hotel industry, they're really starting to see things slow down, and so we're really starting to see the trickle down of these rates. So I guess people are finally hitting their credit card limits, and they're canceling those trips.
Yeah. And I mean, we've hit rates to death. We're talking about it right now, but we won't hit you with all the basically money markets almost at 5%. But I think the interesting part with that is that money market funds have reached over $5 trillion. I mean, we're seeing a lot in our business with our clients. I mean, people are getting 40 basis points in the bank, and you can bring cash over here and do what we call cash management with it. We'll explain a little bit later with money market and T-bills, and you can get 4.5%, 5%. It's quite a bit different. But the one thing we do have a chart that is interesting. Historically, over the last 20 years, stocks have had a positive 3-year return following previous peaks in money market reserves, I should say, or the amount of money in money market. So, hitting the top where again, when does money go into money market? When rates have kind of peaked. That's when people are starting to move into cash and be more fearful, but also get a return. And then, you go into your next market cycle. So that's an interesting.
Well, I think that ties back in, Adam, to what we're talking about with rates, right? So as rates start to peak, obviously the interest you're getting in your money market starts to peak. And eventually, as we hinted at, that there could be potential for obviously pauses here shortly, and then even cuts in interest rates down the road. And that's kind of what I think triggers that cycle of money back out of money market funds and into the market. And so that's where we probably get a lot of those 3-year numbers we've seen there. Yeah,
the psychology there is right. Last month it was 5%. This month it's 4.7. Oh, my interest, keeps going down and down. We got to find another place for this money, whether that's institutionally, so big institutions that are managing money, or it's mom and pop doing their own thing. Yeah, everybody's sensitive to that. So,
well, you probably have some of the herd mentality in there too, right? Usually the flight to quality. The average investor in this country times everything perfectly wrong, and so they got the huge flight to quality over to money market and T-bills, because it shows there that usually when the herd moves, the herd times it wrong, because then stocks end up taking off.
Mm-hmm.
Yeah.
And then the chase begins.
Yeah. So the next area, the housing market. So one area that is definitely doesn't have a good outlook right now, and that's a big part of the economy, and it's a big part of GDP is the housing market. And just saw a chart recently that people are very pessimistic about buying right now, and I don't know that it's just extreme pessimism. It's affordability. It's all factors, right? I mean, this is a confidence chart, but I mean, you can't buy if you have your current house and your rate is 3.5, and then you go to buy a new house and the rate's 7.5. I mean, that it really drops your buying power, and so there's a lot of factors that go into this, but housing is definitely something that isn't doing well right now from a transitioning of people selling houses and buying new ones. There's housing development is slow. There's not a lot of new housing starts. I know we have a shortage in supply. We got rates that are up. So a lot of factors negatively affecting housing right now.
I would say there's a trickle down from that too. I've been watching earnings from like Home Depot and Lowe's and a lot of these other companies that benefit from the housing market doing well, and they're all suffering too.
Yeah,
because that's a big driver for the economy.
Nothing on housing? Nobody?
Well, like you said, I think it's a double whammy, right? So you got high rates and then the high prices. So if you're trying to move from one property to the other, you just doubled your interest rate likely, and you're paying a lot more for probably not a whole lot more house either. And so I think that's a double whammy there.
I did see one. Again, I don't have this chart, but I did see the other day that the median house price has just increased so dramatically because we've been such a real estate boom for a long time, and you have the average house price, going way up, and now rates way up. Those are two conflicting, I guess, two forces driving the same direction with a negative impact on housing. Everything's more expensive, and then it's more expensive to borrow money to pay for those.
Well, difference between a 3.5% mortgage, 30-year mortgage, principal and interest on say $500,000 balance is something like $2,200 in your payment. 7.5, which is about where they are now, roughly. You're talking $3,500. So more than 50% higher in your monthly, regular mortgage payment for the exact same place, for the exact same house, and that's rough. There's not a lot of people that can just crank that much extra expenditure into their budget. So that's really, again, this is by design. I'm a believer that the Fed, they know exactly what they're doing, and they're trying to choke the housing prices down too. So all that adds to the inflation.
Well, that's numbers. A driver inflation, right?
Yep.
So
all that adds to the inflation number. Yeah, for sure.
Yep.
And the cost of their cost of borrowing, right? The government's cost of borrowing. The cost of benefits when they put raises in for Social Security, they all hinge around that same number. So it's in their very selfish interest to manage that number also. They want to make sure that's going.
What was the COLA adjustment for Social Security? Was it 9 last time?
It was a big number.
It was huge.
Exactly what it was.
I mean, that's
8.9.
So for everybody, cost of living adjustment in Social Security payments. I mean, if you're the government and you're paying out Social Security payments to however many million, recipients there are of Social Security, and you got to raise those payments by 9%, that's pretty expensive.
Yeah, I think it was 8.7.
Yeah, it's a very, very expensive proposition. So, thing we've all been talking about, recession. So we got a leading economic indicator chart, which again combines a few different things, kind of shows you, where sentiment is and how things may move based on several different factors, which I'll show in a second. And as you can see, it's further into negative territory. And you can see by the shaded regions there that those are previous recessions. So when you start getting that blue line there moving, well into the negative, which it is approaching now, that's when you start to hit a recession. But like we've talked about before, recession isn't necessarily a bad thing. It's part of a market cycle. It doesn't mean that the world's imploding. It's something that we go through, and there's direction and magnitude. So while we may have a recession, like Chris has just alluded to, that the Fed is obviously driving this direction. They definitely don't want a prolonged deep recession, but they also need to bring inflation down and get some things under control and kind of start a new cycle.
Well, and you said too, there's a lot of things that factor into a recession. A lot of times the market is a leading indicator. And so we've shown the slide, I believe, at least on the monthly market matters, if not a previous roundtable as well, that shows, historically, a lot of the downside to the market occurs prior to entering the recession, right? Because especially with this one here, we've talked about it for a year. So they're pretty well forecasted and the market starts to price that in. So usually that pain is experienced prior to. So entering into recession is almost the time where we start to kind of recover from a market standpoint.
For sure. And if you want to put up that leading economic indicator components chart, just to show people what all goes into that number. Again, you can see the stock market's positive, and manufacturers' new orders down there at the very bottom is slightly positive, but pretty much everything else is negative. And again, that's what's driving that blue line to go significantly negative. Doesn't mean, again, these are all guesses. They're all estimations taken from some previous data, from historical data, but it gives you an idea of where things are at and where they're going.
Kyle, you mentioned it though. I mean, I'm interested to see how this will ultimately affect the financial markets, because we have been talking about recession for a year, and the best economists that we follow think that if we do go through recession, and they anticipate we do, it'll probably be towards the end of this year or early part of next year. So as we've all said many times, is the most anticipated recession in history. Mm-hmm. And so where I wonder is, like, I think I used this analogy last time. It's like we've all seen on the Weather Channel where they've got the hurricane out in the Gulf that's heading towards Florida. If that hurricane was sitting in the Gulf for 18 months and just slowly moving towards Florida an inch a day, by the time it actually gets to Florida, how many people there are like, I forgot to get plywood, Yeah. And so the way that I look at it, we have clients that have made this decision at this point. They're either, I got a diversified portfolio, I don't need the money for a long period of time, I'm just going to ride through this regardless. Or you have other clients that might want to be more conservative and want to remove less risk. But we don't have anyone that by the time we actually figure out there's a recession, they'd be like, okay, now let's get more conservative because I haven't been thinking about this for 18 months. And so it wouldn't surprise me if by the time the recession actually comes and we know that we're in one, most of the people that I know that have wanted to get more conservative, they're not going to start selling at that point. They'll probably start buying. Yeah. And I imagine there's a lot of people in the world that would act the same way. So by the time we actually figure out we're in a recession, which is always backward data, how's the market going to react? And so,
well, I think we talked about it. We talked about it in previous ones as well. Is it's kind of that depth and duration of recession, right? So just because we go into recession doesn't mean everything comes to a halt. It's one of those things. Is it a 2, 3, 4 year recession at negative 4 or 5% GDP, or is it a couple quarters at negative 0.5% or 1% GDP goes
right?
Up?
Yeah.
So I mean, I think a lot of these economists and stuff are leaning more towards that shorter in duration and shorter in depth. It's kind of just we hit a recession and now we're on our way out. And obviously it's data dependent and a lot can change between now and if and when we enter one. But I think nobody's really forecasting a deep, prolonged recession that really just kind of upends things.
Correct.
Well, do we want to talk about debt ceiling? I mean, honestly, I don't want to talk about debt ceiling, but I feel like we have to. I think we've been talking about this for at least several months, for sure on Monthly Market Matters. And I think we've said the same thing, and basically it's played out a lot like we've talked about, that, hey, this is a big political exercise. There's definitely leverage to be gained on both sides, and they're exploiting that leverage. And we're going to get it down to the 11th hour. And I will say we do record this, so by the time this comes out, they may have switched gears and gone a different direction with the debt ceiling limit. But they're definitely going to drag it out to the very end. From everything that we know, everything we read, everything we again from dealing this day to day, this is very, what did you call it, political theater. It's it's front and center of the news. Everybody's going to talk about it. Is the government going to default? We were just talking about it before we even got on this. That I mean, literally, the government's missed zero payments, zero T-bill bond payments in the history of the United States government. So, is it a possibility? Sure. It is. If I were a betting man, I would say this gets resolved at the 11th hour, just in time for just before the money runs out. But we can go.
Well, we have a slide on that too that just shows kind of the debt ceiling. So most people, it's been a little while since we talked about it because they've had an extended period here, but this has happened 78 times since 1960 that the Congress has essentially adjusted the debt ceiling.
But it's different this time, Kyle.
It's different. It's always different, right? Until it's not.
Never different.
So it's really, this just shows too that 2011 and 2013 were really kind of the big ones, where in 11 they they actually downgraded our credit rating prior to defaulting just because there was poor negotiation and wasn't a lot of progress. And so it was anticipation. And so they essentially penalized the country's credit rating. And so the other one was in 2013 where the government shut down for 16 days. But again, kind of showing kind of what the stock market did there, 3 months prior to it, while everybody's sitting here waiting for Congress to act in the 11th hour, market was negative, at least in 2011. But you look at it a year later, once the noise and everything kind of boils over, and they've actually raised the debt ceiling, and I like to call it kick the can down the road because really nothing gets solved.
Well, the 2011 one was I remember that very clearly. That was the first time I'd ever heard of them downgrading U.S. credit.
Yeah.
Yep.
And the bonds went up in price dramatically.
Yeah.
So it's the only time I've ever seen somebody get their credit rating lowered, and it was a positive outcome. I mean, part of the positive outcome was they raised the debt ceiling and nobody missed payments, but that's a huge deal. But the news literally today was that one of the credit rating agencies is about to downgrade U.S. credit, and so you're probably in for a bond rally.
Yeah.
Well, I mean, and when you break it down, the irony is when you break it down to its simplest terms, you're literally talking about politicians agreeing to be able to spend more money. There's nothing they like doing better than spending money. So
Whose
it's
money?
like
Not theirs.
our money. Yeah. Again, they like to spend our money. And it's like this standoff over, are we going to jointly be able to spend more money? I mean, I don't know if I get my kids together and have them argue over whether they're going to be able to spend more money, they're pretty much going to come to the conclusion, yes.
Raise
I think
their
we
allowance.
can do that.
Raise their
Yeah.
own allowance.
Can I spend more dad's money? Sure. I think we can. So again, it's a lot of fear sells, and that's what we're seeing on the news. And really, there's not a lot else to talk about right now. Coming into the summer, so debt ceiling is the big topic.
But we sit here and we kind of joke around about it a little bit just because, it's consumed our days for the last few weeks here. Personally, I don't know about you guys, but I've actually had more calls about the debt ceiling than I did during the, market sell-off last year. And so we're actually seeing an impact in the markets last year with both stocks and bonds. People seem to be a little more calm. I think is because they understood inflation was high, interest rates, there's a war in Ukraine. I think it just kind of made sense. But now the way that the media always tries to sensationalize everything, front and center headline, government's going to shut down and debt ceiling, and without fully understanding what it means and the fact that this isn't the first time we've been here, it's just creating, it seems like, a little bit extra panic right now in clients. And so I want to be sensitive to that, but also kind of reassure clients that, we don't have a crystal ball. We don't know for sure that the debt ceiling is going to get raised. We're just saying that 78 times prior to this, it has. And at the end of the day, our thoughts and our guts are that, they'll figure something out. Neither side's going to get everything of what they want, but at the end of the day, they're going to spend more money. So,
yeah,
and it may not be by June 2nd, but it may be, before or after. Who knows what the actual timeline is? But from a long-term perspective, it's not something that I have a lot of concern on.
Yeah, it sounds like Adam's old possibilities and probabilities. Possibilities and probabilities.
Anything's possible. Anything's possible again, but we can't create portfolios. We can't invest. We can't do financial planning for things that are possible. And when I say possible, I mean in the realm of less than 1%, 0.01% chance. I mean, I always use facetious examples, but they're true. Like, I mean, we could be invaded by aliens, this week. We could get hit by a meteor. I mean, those things are possible, but there's not probable. And so, again, you look at history, 78 times they've raised it. This is politicians agreeing to spend more money, spend other people's money. I think it's probably going to get done. Again, they're extorting leverage on each other to get a few things they want and their pet project needs. But at the end of the day, I think the government will go on and especially bond payments. I mean, listen, there may be some other issues, but they're not going to miss bond payments. That's a very critical part of our government and our financial system working.
If you ever want to borrow money again, then you don't fail on that. And
That's
they
right.
all want to be able to borrow more money. And the thing is too, I mean, when you think about it, like if I owe you money, Adam, and I've got a printing press in my basement, why am I not going to pay you? And so if these guys can just keep printing money, why would they not pay their bills? And the underlying strategy might be to keep inflating money, make dollars worth less, because then 32 trillion doesn't seem like it's worth all that much if the dollar keeps being worth less. And so it could be a long strategy there, but it'd be very foolish for them to fail on a bond, especially when they can just make more money.
Well,
Yeah.
and just to kind of wrap it all up on that, I mean, bottom line is you talk about fear and panic and possibilities and probabilities. I mean, that's why majority of our clients, we have financial plans for, and the financial
Yep.
plans account for market fluctuations, market pull downs. The when or the why may be different each time, but we're accounting for that type of volatility. And in something like the debt ceiling, if they do kick it down the road a little bit longer and take longer to get it approved, there's probably going to be a lot more volatility in the short term in the markets, and we're sensitive to that. We realize that, but we account for it. But history shows that once we kind of get through it down the road, you're better off, and it's one of those things that it's something we plan for. So
Good. Yeah. So along those lines, so top questions from clients, definitely debt ceiling. We just hit that one to death. I think we've got that one taken care of.
What about the banks? If we, what if we see more banking issues, and odds are we will. I don't think that's exactly done, but it seems to be more with the regional banks, Silicon Valley, First Republic, Signature. I'm probably missing a few in there, but it's probably not done. We're probably going to see some more bank failures of the smaller regionals. I'd be willing to bet that the big four, JP Morgan, B of A, Citi, Wells, they really are kind of the too big to fail, but neither here nor there. I mean, even though the Fed is kind of backstopped, even the ones that have failed, or they've organized buyouts, where like, for example, JP Morgan came in and bought First Republic. More likely than not, that's going to happen again. But I don't think it's done, but I think it's a good reminder. Why take the risk if you're above $250,000 in your bank or $500 on a joint account? Why flirt with the risk? But that's my guess is we're probably not done.
Yeah, for sure. And like we talked about earlier, consolidation is part of market cycles. You're going to have, banks, go under when you go into, a recessionary environment. It happened, in the last one too. These were some big banks and big numbers because of the depositors and what type of banks they were. But again, does this affect a client's portfolio more than, just your average, hey, downturn in the stock market or recession? I'd say not. It's just part of the process.
Yeah, the interesting wrinkle to that is commercial real estate. We should have somebody on at some point to
for
talk
sure.
through
That
sort
would
of
be good.
national, not even just local and California, which is going to be probably the most interest to our folks, but just the national landscape on what's happening with commercial real estate and lending and occupancy rates. I mean, there's all kinds of anecdotes about how some of the bigger cities have massive vacancies, but I'd be interested to know some details on what the future looks like, near future for different types of commercial real estate. Because again, we have a lot of interest. Our clientele has a lot of interest, and I'm sure it's pretty widespread. But I'd be very interested to know what some of those details are.
Yeah, for sure. So what other questions?
Well, I mean, I think it kind of goes into a lot of this is, what are we doing, or what can we do, or what should we be changing? What is the outlook for the next 6 months? That crystal ball that we all have, what does it look like? I think a lot of questions have come up because of the debt ceiling, because of the interest rate situation. I think that's led to a lot of clients, like I said, calling in and panic and, should I go to cash, or what should we do? And what changes should we make? And I think that's kind of the question that's come up quite a bit in the last 2 or 3 weeks personally. I don't know about you guys.
Would you characterize, though? I mean, do you have really anybody calling in panicking?
I really have. I've had at least 3 calls where it was, hey, what's a short-term upside versus a short-term downside of us reaching this debt ceiling agreement?
Mm-hmm.
If money market's paying 4.5%, 4.9%, why not park it there till this goes by and then get back in?
Yeah.
So, I mean, it's like the conversation we've all had about time in the market. So it's a conversation I tell clients, depending on your situation, if that makes you more comfortable, that's an option, right? But you're going to have to also be willing to buy back in at a higher price if you're wrong, because with inflation where it's at, long-term solution for you is not cash.
Right.
And that's the situation is we plan for these things in our financial plans that account for market growth and growth of your portfolio to offset inflation and give you those access to greater funds in retirement and permanently parking money in cash. Because like we said, as Fed starts pausing and lowering rates, so will the rates on your money market go down. And so if your
100%.
permanent solution is, a fluctuating interest rate environment, an investment that's going to eventually go down in rates and then potentially buying back in at a higher price in the market, that doesn't make a lot of sense to me. But
Kyle,
so
I was going to say that the danger there too, I was just thinking, because we've all had this conversation about, well, why don't I just park it here to avoid some temporary pain? And we've all probably had clients do this. And the problem with it, and at least the problem I've dealt with, is the market will never do exactly what the client expects it to do. And so the plan immediately starts to change, and immediately they're going to get frozen. And so case in point, I've had more than one client in this position where it's like, well, I'm just going to park here for a little bit until whatever X, Y, or Z event passes. And so let's go with the event you just mentioned. You have to be willing to buy back in at a higher price. Mm-hmm. No one does that. So
it's not very exciting.
Well, and here's the conversation, because obviously they were pessimistic in the event. And so now you call them back, sorry, Mr. and Mrs. Client, it didn't work out. Win some, you lose some. The market's about 4 or 5% higher. Let's go ahead and start nibbling back in. Well, I ain't getting back in now. I'm not going to pay more for what I just got out. If I know this thing's going back down, I'll catch it on the next dip. Yeah. And so they don't like it if the market goes up. And if the market goes down at all because of XYZ event, all it's doing is confirming their fears and saying, I'm not getting in now because I know this thing's going lower. It's like, okay, wait. So if the market goes down, you don't like it. And if the market goes up, you don't like it. Yep. So then you're just stuck and you're frozen. You're frozen in cash. And it's a very, very difficult spot to be in. And many people have been in it. Many of our clients have been in it. And so usually what I recommend is that if you've got that general fear, maybe you just adjust the tachometer a little bit in your portfolio, kind of relook at the long-term horizons, what you're really planning for, and what risks make sense, as opposed to trying to zig or zag. Trade that's really impossible.
The argument makes sense there too, which I know a lot of us do. We try to avoid specific recommendations on portfolios because we all manage our money very similarly for clients, but all different. So, but at the same time, it's having access or resource cash there that we talked about, that short-term reserve. So if you're a client that is in retirement and you're drawing on your account monthly, then we're not going to be fully invested in that money. So maybe it's building that reserve a little higher for an extra couple months to get you through the volatility of the debt ceiling talks or whatever may be on the horizon. That makes sense to me. But all or none bet, let's go 100% to cash for a period of time. You're going to have to be willing to commit to get back in at a higher price is kind of the way that.
And that's what that lifetime income modeling is all about too. And that's something that, I think is pretty easy to show how that works. We typically blend everything together, but it's a pretty sound concept. So we should dive into that sometime too.
Yeah, for sure. Yeah, I mean, generally, I think, and the only thing I can add to that is generally the answer is do not react to what the market's doing. And I mean, honestly, I could say from my own experience, there's so many times you think that the market's going to do something or go one direction and it completely goes the other direction. Now, in the long run, yeah, I mean, things typically average out and we're in a much, much better spot than when I started in this business. And every couple of year period, you're in a much better spot. But over any short period of time, and I know Kyle showed the chart before about all the issues, all the issues that come up. And it's always something. I mean, again, fear sells. You got to have, some immediate concern. You have to have get people to watch, people to act. And that's kind of what we deal with. That's really a big part of our business is helping people not act, not react to, the latest major fear cycle. And not that, hey, but last year was a rough year. I mean, we do go through rough years, but it doesn't mean that, it derails people's portfolio or their financial plan, because that's, like Kyle mentioned earlier, that's some of the stuff we're planning for. It's included.
Well, and I think too, not you guys, but I talk to clients a lot about changes we are making to the portfolio, without getting to specific changes, reactions. It's, we're not sitting here doing nothing. There's been, I've had conversations with clients. It's probably last year was probably the most active we've ever been in managing money. And a lot of that was because of the difficulties we saw in the fixed income market. But it's not like we're sitting here waiting for something to happen and doing nothing. It's proactively allocating money where we think is appropriate, but knowing that we don't know exactly when and where something's going to happen.
This is kind of that back to that direction and magnitude, though, right? Like,
Yep.
so when you talk about doing things for clients, like maybe you switch a position here, or you underweight the portfolio, or make
Right.
it slightly more conservative. Clients are always, and then this is kind of what we're talking about. We're doing things, but ours is go from a 55-mile-an-hour drive to a 50 or a 45, and theirs is go from all in to nothing. Sit down at the poker table, go immediately all in, or pull it all out, and it's just too much of a reaction.
Well,
Good.
And a lot of our stuff too is not reactionary bad news. It's okay. It's factual data. It's okay. Interest
Right.
rates are going up. Bond prices are going down. Maybe we will shorten our duration for a period of time on our fixed income. Well, now that's potentially changing. So maybe we'll go back to the intermediate or longer term duration. So it's changes to investments or styles that are driven or dictated by data or actual market events that are happening versus like you said before, the possibility.
Yeah.
Or doing bond swaps for tax loss.
Correct.
Doing, all those things that add to the old, it's not what you make, it's what you get to keep. And that's the big deal.
Yeah, for sure. So we always end with predictions. I think last time we said, this is about, again, this is mid-quarter roundtable, so this is February. We said probably most of 23 is going to be pretty rocky, 2 steps forward and 1 step back. It's actually been pretty good so far. It's, I would say better than expected. There has been some negative months and some issues, and right now we're at this debt ceiling issue. But judging by where we're at now, anybody want to? Again, this doesn't have to be an S&P price target, but
I'll take a couple stabs.
Okay, go ahead.
So I do believe that the fear around the recession is just going to be hanging, and it makes a lot of investors, a little frozen to make big moves. And so I could see investors being a little apprehensive to be putting more money, especially when we see the bond market paying what it's paying and money market's paying what it's paying. And if interest rates kind of stay where they're at for the time being, I kind of see the market just kind of moving sideways with chop, almost if you took a saw and turned it sideways. So I could see the market kind of moving sideways throughout this year. Wouldn't surprise me if it finishes positive, though. I also wouldn't be surprised if we see tech have a little bit of come out of the clouds. And so I still think, for my opinion, it's a good spot to collect rent, stocks paying dividends, value. So I still think that the general value, I think there will be a little bit of attention back there, but it wouldn't surprise me if we see tech kind of come out of the clouds. Having the run that it's had in this kind of first 4 or 5 months of the year I don't think it's sustainable, but it's pretty insane. The PEs are just getting out of whack.
Well, I'll be the first one to own that. I know that I was one of the ones that gave that prediction as far as that 2 steps forward or 1 step back approach. And I was wrong. I didn't think the NASDAQ was going to go up 20+% in the first, 5-6 months of this year with interest rates still going up. But like we hinted at too, that's, a handful of stocks that are driving those returns. So from an overall market standpoint and just kind of pulse on the economy, I'm still kind of in that camp as far as that 2 steps forward, almost 1.5, 1 3/4 back. Wrong in the fact that I thought we'd likely head into recession the first half of this year. Obviously, that's not going to happen, but I don't know that we're completely out of the woods there. But I do think it will be a shorter duration and lower as far as the depth of it goes. And I wouldn't be surprised to see if it's a little different in that it's almost like sector, like cycling, meaning like certain areas of the economy get hit at different times and it's spread out over the course of a year. So for me, I'm still kind of in that same camp where it's that 2 steps forward, 1 step back. It's going to be choppy and reactionary based on news, not necessarily data. So whatever the, fear that's selling on the TV is going to have reaction. And like Jason said, I'm still kind of in the, all for kind of collecting that higher income. Been a little bit more defensive as far as stuff that is willing to pay higher dividends and interest and instead of chasing the growth. So
that growth conversation, Kyle, I mean, you take the Chat GPT story and just move it 6 months. And then, where's the NASDAQ at that point? I mean, because it's the AI revolution that is that spark, that catalyst. And, very hard telling when that spark was first going to ignite. Turns out that it's igniting in the first part of this year. But I don't know to the trajectory. I mean, none of us can really predict the exponential leap of where AI is going to go, but it's definitely something we're all watching.
Yeah, for sure. Well, the only one I would say, the only thing I've been watching, or one of the things I've been watching closely, is I don't think we'll have rate cuts this year. It'll be again the Fed is has basically you got two different forces, right? You get the market that thinks that rates are going to start getting cut by the end of the year, and then you got the Federal Reserve who's obviously watching various metrics, and they just haven't been able to stagnate growth and bring inflation down as much as they would like. It doesn't mean it hasn't helped. So I think it'll be interesting. But I think we're going to get into 24 before we get any rate cuts. That's just
I could see
my
that.
thought by watching.
I think inflation might be a little bit stickier than some people think. And so, yeah, very possible.
Not transitory.
The transitory ship has sailed.
Okay, just making sure.
Nobody says transitory anymore.
Chris, S&P price target?
Nope. No. I hope we don't have rate cuts this year for one reason only. If they have to start cutting rates right away, they've done way too much damage.
Yep.
And that's the thing that I'd be looking for, more than anything. And I think, the stock market will tell us if that's happening. I don't think there's any doubt that if there's that much damage being done, it's going to come out of earnings really quick, and there's going to be a lot of companies that get smashed. But I hope you're right. I hope you're right that they don't have to cut rates this year, but it'll happen pretty soon. I don't think soon, within a year we'll start having rate cuts go the other way. And again, I think the market will lead that. The bond market will lead that. They'll sort of bond market figures out stuff way before we ever give it credit for. And so we'll see what happens. But yeah, I'm in your, in your corner as far as the 2 steps forward, 1 step back. I don't think you're wrong at all. It's not been a straight line from, January 1st to where we are now. It's been rocky and it's been rough. And, everybody's had, months where the statements show up and they're down a little bit from where they were the previous month. So I don't think there's any change to that. But I'm still pretty constructive on the year. I think it's been pretty good so far. Probably continues to be good, and all the contribution that's made now from the bond portfolios that have been, the typical question is why do we have bond skin? Remind me. And now we remember why. They're definitely diversifier. But they also pay tremendous amount of income now, and that's really additive. That'll give us some wind at our back for sure.
Another thing I always go back to with so we do these predictions for fun, right? But the thing I always go back to is when someone said that you won't know the bottom of the market until 6 months after the bottom of the market. Yep. So it's nice to predict what you think will happen, but again, if everybody was out at the beginning of 23 here. Probably not what you wanted to do, and after a very painful year. So staying the course, staying invested is important. Like always, please share these with anybody who you find you think would find it helpful or at least entertaining, at least get to laugh at us a little bit. We like doing it. You can see we answer questions that we get from real clients in real situations. But if you have any suggestions, topics, questions that you want us to talk about, we're happy to do it. I know Chris mentioned a little bit bringing on a commercial real estate. I think we will start doing that at some point. Start bringing in people in different industries around the community, commercial real estate, residential. There's all kinds of topics that we can bring in and have people chat about. So we love doing this. Hopefully you enjoy it just as much. We'll be back in a quarter in mid quarter 3. In the meantime, check out the Monthly Market Matters. All the stuff's archived on our website. You can always find it there. And thanks for spending a few minutes listening to us.
Thank you all.
Thank you. See
Thanks,
ya.
Chris.
All right, take care.